On October 29, 1929, 16 million shares changed hands in a single day, a record that would stand for decades. The New York Stock Exchange occupied a marble building on Broad Street. It was built to look permanent. On that Tuesday morning, the floor filled with men in dark suits, and the permanent thing started to crack. Visitors watching from the gallery above saw something they'd never seen before. The crowd wasn't trading anymore. It was panicking. By noon, the tape machines, mechanical devices that printed stock prices in real time, had fallen so far behind that traders were quoting prices from 20 minutes ago. They were buying and selling on information that was already dead. But Black Tuesday wasn't the beginning. It was the crescendo of something that had been building for years. The story starts earlier. In 1921, the American economy was healing from the First World War. Factories that had made weapons were retooled for consumer goods. Radio sets, automobiles, refrigerators. For the first time, average people could buy stock, not just the wealthy, the factory worker, the barber, the school teacher. Wall Street saw an opportunity. Brokerage firms opened branch offices in small towns. They hired salesmen. They didn't require much capital to start trading. You could buy stock with 10% down and borrow the rest. It was called buying on margin. The logic was simple. If stocks always go up, why not leverage yourself to the hilt? Everyone was making money. Why not you? By 1926, the market had become a kind of religion. Stock prices had tripled in 5 years. Newspapers ran daily columns about which stocks to buy. Radio announcers gave tips between musical numbers. A Yale economist named Irving Fisher declared that stock prices had reached a permanently high plateau. They wouldn't fall because the economy was fundamentally sound. It was a new era. What Fisher missed, what almost everyone missed, was that the prosperity wasn't evenly distributed. Wages for factory workers had barely budged. Farm income was collapsing. The wealthy were getting wealthier. By 1929, the top 10% of Americans controlled 40% of the wealth. The bottom half controlled just 9%. The system was held together by expectation alone. In early 1929, the cracks started to show. Steel production began to decline. Car sales softened. Building permits fell, but the stock market kept climbing. By August, the market had reached its peak. Then, in late August, prices began to slip. Not dramatically, just a few percentage points, but enough to make people nervous. On Thursday, October 24th, panic selling began. 3 million shares traded hands that day. Fortunes evaporated. The bankers tried to stop it. Richard Whitney, representing J.P. Morgan, walked onto the floor and placed a large order for U.S. steel. It was a show of confidence. The market steadied. For one day, the panic subsided, but it was theater. The underlying problems remained. Over the weekend, people had time to think. On Monday, October 28th, selling resumed. This time it didn't stop. Millions of shares hit the market. Prices collapsed. People who'd bought on margin got a call from their brokers. Margin call. They had to put up more cash immediately or their shares would be sold at any price. Most couldn't pay. Their brokers sold everything. Tuesday came, October 29th. The day we opened on, 16 million shares. Some days the exchange had seen 5 million. Brokers worked through the night trying to settle trades. The ticker machines couldn't keep up. Clerks handwrote prices on chalkboards. The system was overwhelmed. By the end of the day, the ticker didn't finish printing until 7:30 that evening. But the crash wasn't the depression. It was the trigger. Over the next 3 years, stock values fell by 90%. Banks failed, not because they'd been reckless with other people's money, but because they'd been reckless with their own. Depositors lined up to withdraw their savings before the banks collapsed. They had no insurance. Their money was gone. Unemployment climbed. By 1933, 1 in 4 Americans was out of work. Families lost their homes. Breadlines formed in every major city. Shantytowns called Hoovervilles sprang up in parks and on the outskirts of towns. The prosperity of the 20s had been built on debt and expectation. When expectations broke, there was nothing underneath. The economists and politicians blamed different things. Some blamed the Federal Reserve for keeping interest rates too low. Some blamed the tariffs that strangled international trade. Some blamed the banks. Some blamed the stock market itself. The truth was more uncomfortable. The system had worked exactly as designed. The wealthy had gotten wealthier. The poor had gotten poorer. When the poor couldn't borrow anymore, the system broke. What's remarkable is how quickly people forgot. By the 1950s, the market was booming again. By the 1980s, margin buying had returned. By 2008, we'd built an even more elaborate system of leverage and securitization. Each time, the belief was the same: this time is different. The cycle of boom and bust isn't a flaw in capitalism. It's a feature, and we keep mistaking it for a bug. The 1929 crash teaches us something uncomfortable. It wasn't caused by a handful of villains or a single policy mistake. It was caused by millions of ordinary people making rational decisions within a system that incentivized self-deception. Everyone was buying because everyone else was buying. Everyone was leveraged because leverage was cheap. When reality reasserted itself, there was nothing to catch the fall. The Depression lasted a decade. It took a world war to pull the economy out. In that time, tens of millions suffered. Suicides increased. Crime increased. The fabric of society strained under the weight of mass unemployment and desperation. A generation grew up shaped by scarcity. They never forgot it. We remember Black Tuesday as a single day. October 29, 1929, 16 million shares. But the real story isn't about that day. It's about the years that preceded it. The slow construction of a system built on leverage and expectation. The belief that prices could only go up. The willingness of ordinary people to risk everything on that belief. And the collapse when that belief finally shattered. The patterns are still there if you know how to look for them. Leverage returning to the market. Assets priced beyond any reasonable valuation. The belief that this time is different. The confidence that the system is sound. We're not immune to this cycle. We're just living through it again, waiting for the next shock. Subscribe for the mechanisms behind financial collapse, how greed becomes systemic, and why the pattern repeats.